All right, well, always tough to start off after a heavy lunch, even tougher when you've been told in the morning session that as a CFO and a prepare, you're amongst the least trusted group in the entire ecosystem. And then fortunately, Audrey kind of redeemed us a little in saying that the short-term focused, institutional investors that, hedge funds and the others are actually even less like than we are. So I guess that's a good start. So I'm going to talk this afternoon about two different but related topics. Stacy and Chris will follow on with much more detailed discussion. So we're just going to hit some of the key highlights. In enterprise risk management and also in performance reporting disclosures. The quick usual caveat there, views expressed are those by the speaker and not other companies will be referenced, especially important given that lack of trust that we've now been endowed with. Discussion scope, very important to kind of define what we're talking about here, and that is that we're going to focus on enterprise risk management disclosures as you'd see in the core documents, so as in the AIF and the MD&A in Canada, 10K, US equivalents, etc. And also non-GAAP based performance measures and metrics that you'd see again in an MD&A, earnings releases, corporate websites, etc. So I'm not going to talk about anything that's within the realm of GAAP, IFRS, integrated reporting, ESG, much to Alan's regret, Global Reporting Initiative or Carbon Disclosure Project. Okay, so we're really just going to focus on the areas that we mentioned. When you think about 15, 20 years ago, you didn't see a lot of disclosure about risk. You got your core financial statements, a real focus on performance, but you didn't kind of get as much focus on the downside of risk, downside of business results. And there's really been a couple of trends that have contributed to why you'll see this a lot more prominent. Certainly, obviously, international economic change, supply chains are interconnected. So even the total Canadian retailer, yet the supply chain, sorry to tell you, not everything is made in Canada. There are international links, obviously, to any supply chain in pretty much any industry, and that creates more risk to the business model. Increased incidents, cyber sabotage. I'm going to put your hands up if you were an investor in Equifax. Okay, you're a lot smarter than me because I was. And you talk about waterfall. Yeah, we saw that in the week before I exited that position. That was not a happy investment. Increased incidence and severity of natural disasters. So we've obviously had recent experience with the hurricanes. M&A integration risk. We heard earlier today. It's not always about necessarily the due diligence. For many years, acquisitions failed because they didn't do due diligence. What happened? There was a champion within the firm, and they just drove it in and ramrodded across all opposition to it. You don't get that so much anymore. It's a much more balanced discussion in a corporation, but integration risk is still very much in the news. And again, I think we heard the stat earlier today. Half of them fail because of the integration. And of course, a more complex regulatory environment, which we are all aware of. There's a number of studies, so there's a number of initiatives, and not just in Canada, but in the US and globally as well, on looking at this. So I'm just going to touch upon a couple. One that was very interesting last year, I think, the joint CPA Canada CFIRF study on enterprise risk management. A couple of the interesting findings were that 20% of survey participants indicated there was no documented risk management program within the organization. And while there was a great level of awareness of risk amongst the senior management and the board certainly, and committees, it was far less apparent to frontline employees who were actually really on the firing line of where the risk can occur in terms of being react to it and take appropriate measures. 61% of the companies surveyed did not have a chief risk officer equivalent. A lot of that will fall to the CFO almost by default. Marketing people want no part of risk management or the sales or front end part of the business. That will tend to default more to the CFO or in some cases the ops people. On the other hand, on the positive side, and this one I found very interesting, 93% of organizations did address risks on new ventures. So it's interesting that they kind of, the base business will take care of itself, but hey, when we do an acquisition, when we do a geographic expansion, when we introduce a major new product line, there is a good risk management process around that, so the decision is made with those things taken into account, which is found quite interesting. So if we look at what are users of financial statements, what are investors really looking for in disclosures of enterprise risk management? And one thing I should mention is when I'm looking at users, I always kind of consider primary and secondary users. Primary users are the people really dipping their wallets, provide the capital. So those are the current shareholders, prospective investors in equity securities, and also the lenders. I'm not talking about the other interested parties, that have some interest in the organization, but aren't actually dipping into their own resources to do it. So when we look at it, I'm thinking about protecting the people who have actually invested the capital in it. So one of the things they're looking for, clear description of the principal risk specific to the organization. So I know when I was with Colgate Malaysia, we went through a probably 150 to 200 discrete risks of things that can go wrong, and then had to analyze each one of those to decide which the principal risks were. And then within it, which we'll talk in a moment, in terms of a framework of how do you deal with those specific risks, because that'll be important as well in assessing how prepared an organization is for some disaster to happen. Also the board's risk tolerance level. And before I get off principal risks, how many of you believe that cyber risk shouldn't be one of the top 3 principal risks for every single organization today? How many of you do not believe that? Okay, that's good. because regardless of what obviously in insurance and banking, and if you're in airlines and hotel bookings, etc., obviously IT infrastructure, it's core to your business. But even if you're a retailer, manufacturer, or other service provider, it is still today so interwoven. So certainly cyber risk has to be almost by definition one of the top 3 risks regardless of industry today. Board's risk tolerance level, we talked about that earlier, both in terms of quantitative and qualitative. Okay, so the board needs to determine on behalf of the shareholders what's the maximum level of net residual risk that they're willing to accept. Okay, and in terms of the net residual risk, it's going to be what's the risk event, what's the maximum potential financial outcome that can happen should that risk transpire. But then you probability weight that in terms of likelihood over a specific time frame. And this is one of the things that tends to get neglected. We talked earlier about investor timeline. Well, what's long term? Is it 3 years? Is that there has to be a specific timeline. And certainly one we used at Colgate was 10 years. So if something doesn't happens within 10 years, then that's considered to be kind of within your realm. Give and go basically, especially for fire risk, we're in bakeries, there's hot ovens. You're going to have a fire if you extend the time horizon far enough. So you have to be able to incorporate time horizon in terms of the probability of occurrence within a certain period of event. Then what's the impact of all your mitigation procedures? How much of the risk have you laid off through insurance? And when you get through all of that, you'll find that your net residual risk could be, in some cases, just the deductible on insurance policies. In other cases, a much more substantial amount. So you have to determine what the net residual risk is, and then basically quantify that to be able to indicate whether it's within that tolerance guideline. Also interesting for investors would be a brief description of the company's enterprise risk management program structure, accountabilities, disciplines, and which risk framework that they have adopted. And confirmation that all risk types are within the scope. So it's not just about operational risk and fires and floods and all that. It's also about strategic risk, very important. Ask any of the retailers affected by Amazon. I mean, that clearly is one of the biggest strategic risks out there, certainly for all retailers. Not for Canadian Tire, because guys will still go in there because it's fun to have a screwdriver that doubles as a flashlight and and a tire gauge, but for a lot of other retailers, certainly where online is a big issue, then clearly that has been a risk that need to be identified. The company strategy for dealing with principal risks, as I mentioned, it's for every discrete risk, you have choices to make in terms of the combination of avoidance, prevention, mitigation, laying off through insurance or hedging, and finally acceptance. So clearly a risk for every company is, hey, a meteor is going to hit the earth. Well, of course, but what are you going to do about it? There's no cost-effective way of either avoiding it or preventing it or mitigating it. That's kind of an acceptance. So you kind of weight that down through the probability of occurrence to get to where the board, on behalf of shareholders, wouldn't really do a lot about that. Okay. But other material risks that are principal, they do have to have a clearly enunciated strategy. And also an indication of how the less tangible risks, so reputational, not all reputational risks directly affect revenue. That Equifax one, by the way, will immediately, but there are other ones where they're just a bad occurrence happens, where the customers still stay on board with the company, But when you think about if it damages its reputation, future employees, for example, may not want to choose not to work for that particular company that's been subject to a controversy of some kind. So reputational risk is still something that can affect the company, even if it's not directly on the top line, through longer-term sub-optimization. And then, and we talked earlier about, management compensation. And, but one of my bugaboos is one of the worst concepts for business ever was bonuses. The concept of management performance bonuses, because a lot of the short-termism and dysfunctional behavior is attributable to poorly designed executive compensation programs. And you've seen that throughout and the results that happens. So certainly, shareholders are also interested in exactly how are management rewarded essentially for doing prudent risk management, and how is that incorporated into their incentive programs. And also an indication of any emerging risk or something that's kind of new on the horizon that management, you need to know that they've identified it as an emerging risk. It may not be, clear and present danger to the organization itself. But it is something that they need to closely monitor and may even have a preliminary strategy for dealing with it. So as a shareholder or a potential investor, these are the kinds of things you want to see disclosed as part of enterprise risk management. Where are these kinds of disclosures found? Obviously in the AIF is where you'd expect a very comprehensive discussion of risk. But also you'll see a lot of the better reporters do a very detailed version of that. And we've got some examples later. Potash Corporation does an outstanding job in their risk disclosure in their MD&A. So they, and let's, okay, here, quick straw poll. How many people read diligently, and these are ones where you actually have shares, okay, so it's not just part of research. How many of you read the financial statements and notes there too? The GAAP-based, IFRS-based? Oh boy, this whole conference, what are we doing? Seriously, okay. How many people read the info circular where you talk about proxies and see the nice pictures of the board members? And okay. How many people read the AIF? Okay, good, yeah. Now how many people read the MD&A? Oh, okay, a lot more show of hands. Yeah, the MD&A, other than the earnings press release, which I'll ask, how many review the earnings press release? Okay, even more hands. Yeah, those are the two most principled. Those are the ones that move markets. Those are the ones that are most meaningful to the users that actually make decisions. The earnings press release is kind of the initial push the button, not push the button, and then they get the MD&A and the conference calls and everything. They say, "Oop, that was a mistake, undo it," or no, that supports it. Later on, they get to the statements and notes, and at least some people do apparently. But certainly the MD&A is the most read and most important core document to the majority of people, and this room is no different. So generally you'll get the risk, and lawyers will be involved probably a little more in the AIF than they are in the MD&A to make sure you kind of cover the waterfront from a legal point of view. But in the MD&A, you'll get a real business assessment. So some of the principles I talked about earlier in terms of the identification of principal risks, how management is dealing with them, and to provide some assurance that the net residual risk is within the board's tolerance level, tend to be addressed in the MD&A, in the annual MD&A. Now, quarterly, you don't see as much reporting on risk. So unless there is an occurrence of a risk event, or perhaps a fundamental change to the ERP program, or material emerging risk that's arisen, you don't tend to see it in the quarterlies. You'll tend to see it more in the annualies. But very important is the cross-referencing. Is that you may have a really wholesome discussion in your AIF, and then have a smaller version of your MD&A, and then cross-reference. You'll see that a lot. But in any event, all of those, for all of you that do read the MD&A, I think that is an important section. And again, if you look at, you pull the annual reports and MD&As 15, 20 years ago, you just don't see the same kind of coverage. It's becoming more and more important, and we've seen a number of corporate failures that happen not just because of reporting or fraud or anything else, but because a material risk event has arisen, which has caused critical damage to the company, and the company did not have the proper risk mitigation or laying off or whatever the appropriate strategy would be in place. So switching our attention to to non-GAAP. So we talked, obviously at lunch, we heard a lot about performance, and I'm kind of, Linda and I are kind of commensurate. Oh, great! Now we got to learn a new reporting model at this stage in our careers. clearly a need for, even the question after how many years of us having GAAP under its current or previous format, where we're still talking about accounting models, means that, and all the performance metrics, and we heard about, different KPIs, et cetera, and how many of them were, 51, I think the number was. Clearly, we're not getting everything from the core financial statements, even for those that that read them. So that clearly the GAAP alone isn't sufficient for users. Certainly, and especially for analysts looking to populate models, because there's a lot of information that's outside the core financial statements and notes that they need. It also allows a more comprehensive view of performance and a bit more balanced, and not just looking at that one bottom line, as you mentioned, is to basically spread it out, look at liquidity, look at balance sheet strength, and look at other attributes. And when you talk about total performance, and quite frankly, another reason that those are used is increasingly complex accounting. I mean, 20 years ago, accounting was easy. I mean, what was the toughest part? Deferred taxes, income tax, whatever. Now you got bed derivatives and bifurcations and what to do with comprehensive income. And actually, I was listening during lunch today and thinking, he's asking the question, when are we going to pay attention to all the stuff that's down there and other comprehensive income? When I look at the Wall Street Journal and I see price earnings multiples and dividend yields and other stuff, I actually reacted, and I see price over, comprehensive income, then I'll start paying attention to it and believing it. So that's the one holding spot that currently isn't being looked at. But again, if that's the kind of accounting we're evolving to, that's another reason why analysts and users are saying, I don't understand all that stuff. It's not near cash. It's hard to conceptualize. And wait till leases come on balance sheet. Then you can have an asset you can really ignore. All that kind of stuff is another reason why they're going to KPIs and other non-GAAP measures. And the other piece was, and again mentioned at lunch, was the inherent conservatism in GAAP. There's a bit of an offset to that in the sense that there's different realization thresholds for revenue items versus cost items for historical reasons and probably good reasons. But again, the opportunity to show performance in a slightly different light is another reason for using them. And of course, there's some latitude, obviously, in the regulations and the effectiveness thereof. Some common ones, of course, adjusted EBITDA. So this is, I always laugh when I hear, EBITDA is not a GAAP measure. Well, actually, it is a GAAP measure because if people don't mess with it, earnings, taxes, interest, they all have accounting. They're all in accordance with IFRS or GAAP. It is an accounting measure. Now, the issue is you can't always have it as a subtotal. So take a retailer and a manufacturer. In a retailer, you can have an EBITDA subtotal fairly easily, but with a manufacturer, depreciation shows up in two places. It shows up in cost of sales, okay, for depreciation on machinery and equipment, buildings and stuff, and it shows up as part of operating expenses for computer equipment and office furniture and stuff like that. So you can't really have a neat one. You have to have some other kind of format to present it. But EBITDA is a GAAP measure. It's the adjusted, and that's just a personal point as it put with my investor hat on, is when I see adjusted for items, non-recurring, all that, not only do I not add it back, I actually double deduct it to punish management for, hang on a sec, you just impaired an asset you just bought 3 years ago. You're incompetent, okay? You failed to forecast in and you overpaid or whatever. Not only am I not going to eliminate and pretend it didn't happen and you'll never do that again, I'm going to punish you for it, so I'll actually double deduct it. And a lot of other things. So if you see all those impairments and supposed one-offs, and they're not one-offs, and they're just bad management, you shouldn't get away with that through adjusting EBITDA. Okay, so sort of personal note, but I see a lot of I agree kind of thing on that. Yes. Okay. Free cash flow. Sales per square foot, same store sales. Important, and we heard the distinction today in the comment on sales per square foot. It is different even amongst retailers. Okay, so for every retailer, because if it's the same store, it's a new greenfield startup, very easy to do the calcs. But what happens if there's store expansions? Every retailer may have a different decision, especially with integrated supply chains. Go in, take out some warehouse space in the back of the store, more direct deliveries. All of a sudden, you free up floor space. It goes up 10%, 20%, whatever. Each retailer may have a different definition of how they expand the retail selling space within the store. Customer attrition, retention rates, certainly. especially in telcos, et cetera, order backlog and major construction, average cost per claim in insurance, proven reserves, and development cost per ton. You get the idea. You see a lot of these KPIs that aren't necessarily GAAP measures. Whoops, bad move. So yeah, I'll just skip ahead here. Just in terms of quality attributes of those non-GAAP measures, economic relevance, I think the most important is that unless it's truly a driver of value or potentially a leading indicator of future performance, not of much use. Comparability, obviously, consistency across periods, those are pretty straightforward concepts. Paper I'd encourage you to look at, I think it was by Fisher, if I'm not mistaken, was on non-GAAP measures 20-year echo. He did a fairly thorough analysis in 2016, which addresses non-GAAP measures in terms of the reporting quality, governance, regulation, and industry-specific usage. So encourage you to read that. So the shifting, this was encouraging. We were talking during the break about how even the regulators are starting to, how should I say, explore this in a little more detail. So there are amendments to CSA Staff Notice 52306 in 2016 that certain performance measures aren't considered non-GAAP measures if they're purely numerical, don't involve dollars and cents, or if they are derived directly from financial statements, which is an encouraging development, I guess. But provided it's not named in a way that, you have to distinguish it from other similar kind of measures and make sure that it's not misleading. Talked earlier about the allowance for certain subtotals, but continuing issue with reporters and press releases, corporate websites. So even though a lot of times the MD&As and AIF still have sufficient space to fully explain and comply with the requirements, and sometimes they try and use shortcuts in press releases and other things. So what can management do in order to provide better input to the analysts and to the users of financials in this space is ensure it does provide incremental useful information that isn't already available for the statements, that the info can't be misinterpreted, that is subject to an internal control process. I can tell you Canadian Tire, literally we've put a whole lot of effort into every single metric in there and had double checking, triple checking, and all that kind of stuff. So any of that non-GAAP stuff is still may not be audit level assurance that you're getting as you would in core financials, but it's certainly very thorough reviewed, as I know it is for a lot of major companies. And ensure the reporting metric conforms to the regulatory requirements, including reconciliations, et cetera, where needed. And really, to do this, stay on top of the regulatory amendments, obviously. Review annual reports of award-winning corporate reporters. I mean, you look at the TELUS's, the Potashes, the Canadian Tires, et cetera. Perennial winners of reporting awards, either in their category or globally. They always have good examples. Review annual reports of competitors within your own industry. Follow developments internal in evolving frameworks such as integrated reporting. And look through the eyes of users. Ultimately, it's the ones who are actually putting their own money on the table that are really the best judges of that. So again, there's some appendices. There's when you see the thing Potash and Canadian Tire, just some examples of some good reporting in that space. Okay, all right, thank you.